name is Armando Balbuena, Marketing Manager at Sonen Capital, and your moderator for today's webinar. A few housekeeping items before we begin. We definitely encourage your participation, so please submit questions using the questions panel. Throughout the presentation, we'll be managing the questions coming in and then answer them at the end. Those questions that remain unanswered will be addressed and emailed out to everyone along with the link to the audio recording of the webinar. In our last webinar about our annual impact report, we had about 24 questions that we didn't have time to answer. So we wrote responses and sent them to all attendees. These questions are how we get better at what we do and help provide more informative content going forward. We also take your time seriously, so whatever we don't have time for, we'll address over email. For those of you just joining us, this webinar is based on our continuing series of impact investing frameworks, all of which can be found in the thought leadership section of our website. Sonen develops these impact frameworks to better understand the nuances, investment opportunities, and develop guidelines for specific themes of interest to investors. In each impact framework, we identify the major social and environmental drivers that we observe are related to each theme and how those drivers relate to or potentially create impact investment opportunities. To date, we've published impact frameworks on energy, water, sustainable agriculture, and topics for faith-based and divestment investors. And now, I would like to introduce today's presenter, our Director of Impact here at Sonen Capital, Will Morgan. Will has been working in the field of impact measurement for over a decade. He leads Sonen's efforts to define, evaluate, and report impact across Sonen's public and private markets investment strategies. He was one of the earliest practitioners of IRIS, the catalog of generally accepted impact performance metrics, and has helped some of the largest US and European-based foundations integrate IRIS into their internal impact evaluation systems for both grant-based and corpus-based impact portfolios. Will, welcome, and take it away.
Thank you, Armando, and thanks everyone for attending today. We're pleased to see so much interest in this topic. I'm going to make remarks for maybe about 10 or 12 minutes, and then we'd really like to open this up for questions as Armando suggested. As Armando noted, these frameworks are really intended to help guide our investment decision-making process on an internal basis. On an external basis, it helps clients understand how we think about specific impact themes and what kinds of things we hope to achieve through investing on a very intentional way. When we create these impact drivers, we first identify what we think are the most salient problems or challenges related to the topic at hand, in this case, real estate. We call these challenges the impact drivers, and we categorize the impact drivers into three major kinds. First, macro trends. These are broad-ranging global phenomena. Social trends encompass issues which really relate more closely to the human experience, and environmental trends which relate largely to humans' impact on the planet. After we identify these drivers, we then establish a vision for what our impact investments will do. We call these our impact outcomes. These impact outcomes are intended to redress the major related social and environmental drivers that we've identified and help us capture the most impact potential that is possible per invested dollar. Each investment theme, such as water or agriculture or real estate, we identify both social and environmental impact outcomes. Then, using a typical approach borrowed from a strategic planning model, after we identify these outcomes, we work our ways backward to identify specific investment objectives and strategies that it will take to get us to our intended outcomes over time. The strategies really are how we will get there. For sustainable real estate, we've invested four major drivers. That is, these large-scale, inarguable facts that we can easily observe, but also include enormous investment opportunity and an opportunity for positive impact creation. We'll walk through these four drivers briefly here. This first macro driver is the immutable fact of population growth. The world today is going to see more than 5.5 billion additional inhabitants by the year 2100. That means we're going to have 11 billion people on the planet in 80 plus years. Those people will invariably need somewhere to live and somewhere to work. Most of that growth we know is going to happen in urbanized areas, in cities, and it's going to occur predominantly in emerging economies in Asia and in Africa. Buildings are the largest singular emitter of greenhouse gases, and thus, we think, carry the greatest potential to significantly reduce humans' contribution to climate change. The built environment itself is key to helping our civilization get on a path to greater sustainability. The next driver we can easily observe is the acute global shortage of affordable housing options for lower income populations. This is not only happening in San Francisco and Boston and in Austin in the US, there is a global shortage of affordable options, and it's exacerbated by a supply that is just simply not keeping up with human population growth. As I noted, growth is going to occur largely in urban areas, and that's where these shortages are already most acute and persistent. Simply put, we just have to build more housing to accommodate our planet's growth. And this is particularly true for the growing population across the planet that has diminished financial resources to put to use for housing. And our next social driver is the growing lack of social equity, and we'll define that subsequently. But this is really the growing inability for less privileged populations on our planet to avail themselves of basic services, things like transportation, access to health care, good jobs. And we want people to help be better able to participate fully in our economic system. In the US, the growth in rental households over the next 8 years through 2025 is going to occur almost entirely among minority families. We've based some of our research on the Harvard Center for Housing Studies, and we've learned that most of all of those renter families are going to have incomes below $30,000. Furthermore, in the US, there are more than 11 million people who pay more than half of their income on rent. We know that such a burden suggests that when you have to pay that much money just for rent and for your housing, educational achievement often is compromised. Economic prosperity is much more complicated, and we've also seen a greater correlation with poor health outcomes when so much of your resources are going just to put a roof over your head. Last, an easily observable environmental driver is climate change. As I noted before, buildings themselves generate a full third of all global greenhouse gas emissions, and they consume 40% of all the energy use. That's the single largest contributor as a whole to climate change. And as it stands now, the built environment's carbon dioxide emissions are going to grow faster than any other sector through 2030. Again, we think buildings are where the most cost-efficient and impactful opportunity exists to reduce our contribution to climate change. So as I recite all of this data that we have found, it all sounds pretty gloomy, and we're trying to reframe this as how all this data can present opportunities for us. And we actually have great optimism that if we invest with a focused intention, we can address these trends that we just reviewed, and we can help create a future for our generation and for future generations, which is going to be better than what we have now. Given these observations, we have identified two simple outcomes that we wish to see that will result from our real estate related investments that we make. The first, enhance and increase the built environment's sustainability performance. This is a fairly simple objective, and it actually can be achieved through numerous different strategies and approaches. The second intended outcome is focused on the social dimension of this topic, and that is to increase social equity and accessibility in the built environment. This means helping people or helping provide greater opportunity for lower income families and households across the globe. So how do we do this? Here's where we identify specific impact objectives and corresponding investment strategies that we think will help us achieve our goals. First, we're going to enhance the sustainability performance within the built environment by decreasing buildings' direct carbon footprint. This can be achieved by pursuing strategies that expand technology's capability to reduce energy use and by expanding the use of renewable energy for municipalities of all sizes. In public markets, this can look like retrofitting buildings for greater efficiency through municipal bonds or green bonds across many different kinds of fixed income securities. Public markets also provide opportunities to invest in renewable energy infrastructure and renewable energy producers that serve cities and urban centers. In private markets, this can include renewable energy production as well as innovative technologies that can help save or reduce energy consumption. Think of smart thermostats or new window coverings that can actually generate power or regulate temperature. Many of these technologies are under development now and they're not widely used, but we know that they will be necessary and they will be a big part of the built environment in the next generation. Our next second objective is to decrease materials use. Globally, it's hard to believe, but buildings use 40% of all raw materials, and they consume 14% of all potable water. Underlying investment strategies here focus on retrofitting and reusing existing buildings and making use of an existing infrastructure rather than just building more. Using existing buildings just uses less resources than building new ones. And here we also want to prioritize maximizing the use of reused and repurposed materials. In public markets, we see municipal bonds and green bonds that can be used to retrofit and upgrade buildings for greater resource efficiency. Listed equities also often provide opportunities to support technological development that can optimize resource use and efficiency. In private markets, again, we see fund managers that are focused on retrofitting existing buildings and developing technology that can optimize resource use within buildings. Our third and last broad impact objective is to decrease waste. Again, an amazing fact here is that 30% of all the waste production in the U.S. comes from the construction industry, and most of that waste is actually recyclable. That is the equivalent of 170 million tons of recyclable content that goes into landfills that could otherwise be reused or repurposed. Underlying strategies here include basic focus on reusing and repurposing buildings and minimizing construction debris. Public markets opportunities in this domain include municipal waste management that boosts recycling rates, power generation from municipal solid waste, or even REITs that emphasize efficient waste management and recycling programs across underlying properties. Private market opportunities look much the same and include innovative ways to generate power from waste, the creative use of debris that would otherwise go into the landfill through recycling or repurposing, and even property funds that incorporate waste reduction and recycling strategies into day-to-day management. Next, our second intended impact outcome, as you recall, relates to social equity. We want to increase social equity and accessibility in the built environment. So what does this look like? We're using a definition of social equity from a paper that was just recently published by our colleague Catherine Pease. And this is it means fair access to livelihood and education and resources, and it means a full participation in all facets of community life, including political, economic, and cultural dimensions. So our first objective here is really about location, and we're talking about real estate, so I have to talk about location. We need to focus on well-located housing options for lower-income renters and homeowners. We're seeing across both public and private markets, we want to pursue opportunities that target specific geographies and locations which have particular need, and we want to favor the principles of smart growth and social equity wherever we can. This includes housing that's conveniently located, it's near jobs, it's near urban centers, it's not in far-flung locations, it's inconvenient. And it means helping people gain that full participation in our economic system. Our second objective is to simply expand the supply of affordable options. We need to make more units. And strategies for increasing the supply does include new builds and new buildings in the most constrained markets and geographies. And we are trying to foster greater rates of home ownership, particularly among low-income populations. Here we see opportunities in both public and private markets that include financing mechanisms, affordable loans, and other interventions that boost home ownership rates among targeted populations. New builds also is another activity. We want to focus those new builds where the market is most constrained, and that is to do so with the intention of increasing supply, specifically to increase social equity. The last element of our impact frameworks are what we call our guidelines. These essentially spell out our position on issues that are related to each impact theme, and these guidelines are included in each of our different impact frameworks. Often they include our position on sometimes controversial issues related to the specific theme, or it may just be a clarifying statement on related topics. We've found actually that guidelines like this, as simple as they are, they're extremely helpful for us in investment decisions. They form an easy way for us to qualify or disqualify an investment, specific investment or an investment fund or a manager from consideration. It just really helps put some guardrails onto our decision-making process. These guidelines are spelled out in detail in our published framework, which is available on our website. So I'm just going to go through a couple of them for brevity here. The first is resource use. What we really want to do, we're saying support best practices. We want to ensure that we emphasize water and energy savings, and we want to seek the use of repurposed and recycled materials to the maximum extent possible. The next is sustainability governance. We really prefer investments that have, and underlying properties that have explicit sustainability elements integrated into governance and staff functions. We've seen some evidence to suggest that dedicated sustainability functions within governance structures actually results in improved sustainability performance, which is not a surprise, but it also results in improved tenant satisfaction. We also prefer investments who take tenant satisfaction into account at regular intervals. There's clear evidence that indicates that properties have, with this tenant satisfaction survey in place, have lower rates of turnover, they have higher rates of tenant satisfaction, and that's not all that surprising, really. Last, climate change. It's fairly clear in our previous discussion. We're just trying to codify this here and state that any underlying property must have a lower emissions profile, and it must have improved rates of resource use, either over time or relative to closely comparable properties. And wherever possible, we like to see these third-party sustainability certifications, such as LEED or BREEAM, simply because it helps validate our approach and that the underlying properties have that third-party certification in place. So that concludes my segment of this presentation on our impact frameworks. As Armando noted, we have other frameworks that include energy and water and sustainable agriculture. We've got 2 additional ones underway right now. They use much the same format, and they're all available on our website. I'm hoping we can devote some time to answer a few questions in the next 5 or 10 minutes. Thank you.
Thank you, Will. And let's get to a few questions that came in right at the beginning while we look at the some of the others here. Someone asks, are your investments in sustainable real estate focused mostly in the U.S. or are they global in their scope?
Yes. Okay. Well, we have one strategy in place now that has invested in real estate specifically. That's an explicit impact theme that this particular strategy is pursuing. And in that case, we've made two different investments in fund managers, one in the U.S. and one in South Africa. The one in the U.S. is focusing on rehabilitating and renovating existing buildings in large urban areas where there is a definitive lack of supply. What we like about that particular manager is they've made great strides in improving environmental performance of the buildings, but also lots of different dimensions in how they evaluate tenant satisfaction with walkability scores and access to transit, some of those dimensions that I mentioned earlier. The investment in South Africa is, I think, fascinating. It's an excellent illustration of how you can get social dimensions of impact creation and environmental dimensions of impact creation. This fund is working for the workforce in South Africa and in peri-urban areas around Johannesburg. There's a burgeoning middle class in that country that is in acute need of more housing options. And so they're actually building new buildings in order to provide that supply, but which has a great social story to it. But the other aspect is that there's a tremendous increase in environmental performance, and they measure environmental performance through reduction in materials use and an increase in water savings and an increase in energy efficiency. So these opportunities abound both in the U.S. and abroad. All over the planet, there's a multitude of opportunities.
You just touched a little bit on impact measurement, and we had a question that came in on how do you measure impact performance as it relates to real estate?
Okay, great question. So yes, impact measurement is a fundamental part of our business. We invest for financial performance and impact performance, and so we report very explicitly on both. In the case of real estate and all of these discrete impact themes, we have come up with specific impact indicators that we use to evaluate the efficacy of our approach, but also that helps us understand whether or not we're getting to the intended impact outcomes that we want. So we have articulated specific sustainability outcomes ourselves. In the case of real estate, we do have a series of indicators. We have a group of core indicators, 3 different core indicators that any investment related to real estate must report upon. We have a series of supplemental impact indicators too, which often just provide a little additional data for us. Typical indicators that we're talking about now are energy savings that result from property improvement, how much of the property may have benefited from energy efficiency improvements in terms of square meters, and then how much of the properties have sustainability, third-party sustainability certifications. We also like to measure the total number of units, and of that total number of units, how many of those units have been dedicated to low income or affordable rates for rental or for home ownership. I'll just note all of that is elaborated upon in our annual impact report. We share all that data widely.
Thank you. Will, any questions within the role here that you're looking at?
Sorry, Armando?
Well, I'll just pick the next one in the row here. We have a question on litmus tests. So what are the litmus tests used in judging the value and outcomes of impact investing in real estate?
Interesting question. Well, I think I might have revealed that in a previous slide.
Yeah.
For example, if we're going to invest in a specific building or a specific fund, unless there is a demonstrable improvement in the sustainability profile as measured by resource use, energy use, water use, or the percentage of repurposed materials, for example, we need that delta to justify an investment. It may have phenomenal financial returns, but if it is no different than the next building down the block, that doesn't justify it from an impact perspective, and we would have to take a pass. So we really do want to differentiate our investment strategy by how we pick properties in fund managers that have a demonstrable improvement in the sustainability profile. So that would be a litmus test. If that's not there and it's not something that's easily measured, or it's not something that the underlying investment intends to measure, that's not a good fit for our investment platform.
Mm-hmm. Someone here asked a question regarding waste management and waste to energy opportunities. We'll see how deep you can get into these, but how does waste management and waste to energy relate to real estate?
Yeah, that's a good question. So, one of the challenges with real estate is it's so far-reaching. It includes so many different kinds of industries and sectors. But the truth is, real estate can be used as a proxy for just the built environment and what humans are doing and their impact on the built environment. And one of the biggest impacts from the environmental perspective is humans' municipal solid waste and how we manage that. And so if we think about 5 billion more people on the planet, we have to think about how do we manage the waste that comes alongside. And that's true just for day-to-day operations as well as construction that happens to accommodate people. So there's just a huge opportunity to work with buildings and property managers who are actually trying to reduce the municipal solid waste volume and trying to redirect it and repurpose some of it. And we want to work with properties that have thoughtful and systematic waste and recycling schemes that are possibly integrated into the whole building in order to help reduce the human-generated waste stream. So we think real estate is just an easy entry point into how, excuse me, how we can further advance sustainability. And
we'll choose one more question here. And what type of investment vehicles does Sonen look at to express its mission in this area?
Oh, great question. Again, as I just mentioned, the real estate is so far-reaching. It includes everything from all the building materials and the technologies which may go into building, but it also includes the dirt on which the real estate exists. So, and this is why in some of these frameworks, in all of them actually, we try to articulate what differences there are between public market strategies and private market strategies, which help as you invest in real estate. So, we have one private market strategy that's really focused on actual buildings and properties, and in this case, we're able to get great visibility on the underlying performance of those buildings, what the sustainability strategy is, and we can get great data on how those buildings are actually performing with respect to environmental and social sustainability. But again, we've taken great care to articulate how technology may play a part in the real estate world and in the built environment. And as I said, we're seeing these smart thermostats and we're seeing these window curtains that can cover windows and actually reflect a lot of the heat away from the building, so it helps regulate the internal temperature. And so we can imagine investing in real estate as the large umbrella, and we can imagine doing that in municipal bonds, we can imagine doing it in corporate bonds, we can imagine doing it in listed equities, and we can imagine doing it in real assets and in private equity. It's across all those asset classes, there are ways to participate in real estate investing.
Well, thank you very much, Will. This is all the time we have for our webinar today. We have several questions that remain unanswered, but please look at our follow-up email that will alert you to the on-demand status of the webinar and answer any remaining questions. On behalf of Will Morgan, as well as the rest of the Sonen team, thank you for joining us. We hope we've added to your knowledge on this topic. Until next time, my name is Amanda Balbuena. Have an excellent day.